Most people think that investing in the stock market is this super complicated task that requires tons of research, or that you have to be good at math to invest. That's total BS. I'll tell you just how easy investing can be, and if by the end of the video, you're not convinced, you can unleash your rage at us in the comments below. Imagine you could own shares of hundreds of the biggest companies trading today, and that you could do it with even a very tiny budget in a few simple steps. It isn't too good to be true, and it is in fact a great way for beginners to get started in the stock market. Today, I'm breaking down exactly how to buy index funds so you can grow rich over time.
Of all the things that have happened since 1942, we've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars, we had 9/11, we had the Cuban Missile Crisis, we have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund.
So what is an index fund? Well, I already gave you a bit of a hint earlier. Index funds are a type of mutual fund. They are designed to track the performance of an index, such as the Dow Jones Industrial Average or the S&P 500. Index funds typically charge lower fees than actively managed funds because they do not try to beat the market. Instead, they simply invest your money in all of the stocks in a particular index, regardless of how well some may be doing more than others at any given time. Index funds work by investing in stocks in a way that usually closely reflects the market as a whole. Most mutual funds use an active management strategy where a fund manager actively chooses when to buy or sell specific stocks. Since there is someone doing the work of choosing these investments, these types of mutual funds tend to have higher fees. On the other hand, index funds use passive management strategies based on building a portfolio of investments that reflect an existing market index, such as the S&P 500. Even though fund managers do a lot of work to beat the market, the truth is that they very rarely do. And even when they do, it is highly unlikely that they will continue to beat the market over the long term. Only 29% of actively managed funds beat the S&P 500 in 2019. In 2021, only 9% of those funds continue to beat their benchmark. Index funds are also low cost, which means you can put more money into them than if you were paying high fees on individual investments. They also provide diversification across a variety of assets while lowering investment risk overall because they don't suffer from the pitfalls of individual stocks and bonds, such as company bankruptcy or interest rate fluctuations. So why would you want to invest in index funds? To put it bluntly, they are less expensive and usually do a better job matching the market than actively managed funds. Win-win. Give this video a like if we've given you value so far. This will make the YouTube algorithm go crazy and start pushing this video out to tons of people, so our community grows even stronger. So, you know you want to use index funds to get started in the stock market or to build up your existing portfolio. How do you decide which to invest in? The good news is that index funds can be used to support just about any investment strategy. You can use index funds to diversify your portfolio by investing in the stock market, bonds, real estate, and more. Index funds allow you to buy fractional pieces of an asset instead of buying the actual asset itself. For example, if you wanted $1 million worth of Apple stock, it would cost you $151 per share as of April 2019. Instead of buying all those shares yourself, you could invest in an index fund that holds Apple stock and pay less than $100 per share for all $1 million worth. This gives investors access to assets they might otherwise not be able to afford without paying excessive fees or commissions, along with high penalties for early withdrawal from retirement accounts such as 401ks and IRAs. Index funds are an awesome option for investors who want to invest in real estate but don't have the time or expertise to do so themselves. For example, if you wanted to invest in commercial real estate but didn't have the time or expertise to do so yourself, you could buy shares of an REIT, Real Estate Investment Trust, that invests in commercial property instead. Think about your investment goals, where you want to diversify your portfolio, and what your investment timeline is before you choose which index funds to invest in. You'll want to decide if you're going to invest in a mutual fund or an exchange-traded fund or ETF. A mutual fund is your standard investment vehicle. It's usually hosted by a company like Vanguard or Fidelity and contains a collection of investments that are chosen by an expert professional team at the company. These can be balanced or specialized depending on what you're looking for. ETFs are like regular mutual funds, except they trade throughout the day like stocks do and don't require any kind of oversight from an advisor or other third party. There are a few things to keep in mind when it comes to buying an ETF that may be different from buying a mutual fund. First, ETFs have lower fees than traditional mutual funds. This is because there's no need for a third-party administrator like Vanguard or Fidelity. You can do it all on your own through your brokerage account. Second, you have more control over the investments you're making because you can choose which sectors or companies you want to invest in. It really comes down to exactly how involved you want to be, what best supports your goals, and what it will cost you to invest. Pay attention to the administrative costs and market opportunities of each fund you're considering. Still feeling lost? I've got you covered. Here are some great options for getting started in index funds. First, the Fidelity 500 Index Fund, FXIAX. This is one of the longest-running and most popular mutual funds in the U.S. It's been around since 1988 and has returned an annualized 10.5% dividends reinvested. Plus, its expense ratio is a rock-bottom 0.015%, or just $1.50 for every $10,000 invested annually. This is a good choice for getting your feet wet with an index that mirrors the S&P 500 and gives you a super broad representation in 11 market sectors. Another solid choice is the Vanguard Balanced Index Fund Admirable Shares, VBIAX, which is a mutual fund with a low-cost structure. It's made up of two allocations, U.S. stocks, which track the Dow Jones Total Stock Market Index, and U.S. bonds, which track the Bloomberg Aggregate Bond Index. These are held in 60-40 allocation and have an excellent history of returns while providing a nice balance of stocks and bonds. This one has an expense ratio of 0.07% and requires a minimum investment of $3,000. And if you want to take it global, check out the Vanguard Total World Stock ETF, VT, which is basically the king of index funds. It holds over 9,000 stocks from U.S., international developed, and international emerging markets. Plus, it covers all 11 market sectors and small, mid, and large cap stocks. This is basically like an investment in the entire global economy. And even though it's an ETF, you can stay totally passive, since the ETF automatically rebalances itself. This one is going to run you an expense ratio of 0.07%. Okay, you know what you want to invest in, now let's get to buying. You can buy an index fund directly from the fund company or through a broker. You can buy online, in person, or by asking your 401k plan administrator to add it to your portfolio. The choice is up to you, and each has its own pros and cons. If you buy through a broker, the fees will be higher than if you bought directly from the fund company. This is because brokers are paid by mutual fund companies to sell their funds, so they make money off of every sale. The more sales they make, the more money they make, and that means higher fees for investors like you. However, some brokers have lower fee structures than others. If you're looking for a low-cost option, make sure to do some comparison shopping before making your decision. If you're looking for a super easy online option you can get started with as soon as this video is over, check out E-Trade, Fidelity, Charles Schwab, or JP Morgan's self-directed investing. All have no account minimum and don't change fees for trades. Now that you have your index funds, it's time to monitor them. How often should you check in on your investments? The answer is different for everyone. If you're someone who gets nervous about market swings, then checking in daily or weekly might be best. However, if you're the type of person who likes to look at the big picture and see how things are going over several months or years, then checking in every few months might be better for you. Regardless of when and how often you decide to monitor your investments or not, there are some things that all investors should always keep their eyes on when it comes to their portfolio. First up, fees. Some mutual fund companies charge a fee called an expense ratio, which we've mentioned throughout this video so far. This fee goes toward paying operational expenses such as salaries and office supplies. A higher expense ratio means that less of your investment dollars will actually go toward buying shares, so keep an eye out for changing fee structures. Next, fund values. When comparing funds with the same strategy like international small-cap value stocks, it's important to compare more than just their short-term performance metrics. Other factors like risk profiles also come into play here. A good rule of thumb is to start panicking only when the fund's performance lags the index by much more than the expense ratio. And finally, you'll want to keep an eye out on how your index funds are aligning with your overall investment goals. All investments are a risk, but if you hold an index fund for the long term, you are most likely going to see an increase in value. Keep the long game in mind. Index funds are a great way to get into the stock market. They're low cost and easy to buy, and there are so many different ways to invest in them. Don't forget, once your investment is set up, make sure that it stays on track by monitoring it periodically. This will help ensure that your funds continue earning returns without losing any value over time. If you want more tips like this, make sure to subscribe to the channel and check the links in the description below.